Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intel.
If you find our tops useful, please consider subscribe, like, and comment underneath. And before we really get going with today's analysis, I just want to quickly mention StockOracle.
Right, yeah, the tool we use for a lot of this research.
Exactly. So there's a special 14-day trial link down below in the description. StockOracle is this AI-aided stock research platform.
And just to be super clear with everyone listening, it's not financial advice, right? It's not a trading signal service.
Yeah, definitely not. Not real-time market data either. It's just a really robust research tool. Also, that link below is an affiliate link, meaning the channel may earn a commission if you use it at no extra cost to you.
But, please remember that StockOracle's AI insights and their valuation estimates, they can be incomplete. Sometimes they can just be outright wrong.
For sure. Always verify important facts yourself. So, Intel.
Man, Intel.
I mean, just imagine a $500 billion tech giant, right? And they are just bleeding billions of dollars in cash every single quarter.
It is honestly hard to fathom the scale of it.
And they are actively firing over 20% of their workforce just to survive. But, and this is the crazy part, if you look at their stock chart over the last year, it's surged over 140%.
Which just feels like a complete contradiction.
Right. So we really need to unpack this today, because we are dealing with a company that just posted a stunning 25% revenue surge, but they are simultaneously draining their coffers to fund this unprecedented manufacturing build-out.
Yeah, they're tearing themselves in two totally different directions.
Exactly. So the goal today is to figure out if this legacy giant is actually pulling off a historic turnaround, or, I don't know, if they are just incinerating cash in this final desperate bid for relevance.
And the stakes for this, they go way beyond just a single ticker symbol. Intel is basically a fundamental bellwether for the entire tech sector's transition into the AI era.
Because everyone is watching them.
Yeah, we're looking at a company that historically defined Silicon Valley, lost its crown, and is now attempting literally the most expensive pivot in corporate history.
Which is wild.
It really is. What happens to Intel over the next 18 months will either validate these massive capital expenditure cycles we are seeing across the whole market, or it's going to serve as a terrifying warning about the limits of legacy infrastructure.
So let's start with the wealth building context here and look at where the actual cash is coming in right now. Because, if you just look at the top line revenue, you might actually think the turnaround is already complete.
The top line does look incredibly strong right now.
Right. Second quarter 2026 revenue hit $16.128 billion. That is up 25% year over year.
Wow.
Yeah, it's the strongest quarterly growth rate Intel has recorded since all the way back in 2010. They bottomed out in 2025 at around $52.8 billion, but now they are pacing toward an annualized run rate of nearly $65 billion.
So the engine is definitely firing again.
The engine is firing, but, the composition of that revenue, that's what dictates the future.
Right, you have to look under the hood. When you break open that $16 billion quarter, it becomes immediately apparent that this isn't just a broad rising tide situation.
Meaning not all divisions are winning?
Exactly. The traditional client computing segment, the division responsible for the chips inside standard laptops and desktops, that brought in $8.9 billion.
Which sounds huge.
It sounds massive, but it only represents a 1% growth year over year. It's basically stagnant. The division that is single-handedly dragging Intel's top line higher is the Data Center and AI segment, or DCAI.
And that division posted $6.3 billion in revenue, up 59% year over year.
Yeah, with a 40% operating margin. That yields $2.5 billion in pure operating profit. It is a phenomenal acceleration.
So they are printing money in AI.
Basically, yeah. DCAI is effectively subsidizing the entire corporate restructuring at this point.
But I look at that dynamic, and I have to challenge the narrative a little bit. When you hear 59% growth in AI, it sounds like absolute dominance. But let's look at the broader landscape here.
You mean NVIDIA?
Yeah, NVIDIA is still lapping Intel multiple times over when it comes to high-end AI accelerators and GPUs. So are they actually winning in the data center, or are they just, catching the overflow?
Catching the overflow.
Yeah, meaning the hyperscalers, the Amazons, Microsofts, Googles, they have so much AI infrastructure demand that they are just buying whatever silicon they can get their hands on. Is Intel just benefiting from a supply bottleneck elsewhere?
That is the defining skepticism surrounding this segment right now. But it kind of misses the mechanical difference between how these AI chips are actually deployed.
Okay, how so?
Well, NVIDIA undeniably owns AI training. That's the incredibly compute-intensive process of teaching a large language model how to function.
Right, which takes thousands of massive GPUs.
Exactly. Yeah. But once a model is trained, it has to be deployed in the real world to actually answer user queries. And that phase is called inference.
Okay.
Inference doesn't always require a $40,000 NVIDIA GPU. Often, it runs highly efficiently on optimized CPUs and specialized accelerators where Intel already has deeply entrenched relationships.
Ah, I see. So they aren't necessarily trying to beat NVIDIA in a foot race to train the next GPT model. They are just waiting at the finish line to provide the hardware that runs the day-to-day operation.
Precisely. And financially speaking, they don't need to dethrone NVIDIA to survive. Intel's internal models project that they reach GAAP break-even at roughly $56 billion in annual revenue.
And they're currently on a $65 billion run rate.
Right, so that DCAI growth is providing the critical life support required to clear that break-even threshold. If they maintain this trajectory, 2027 could deliver their first annual GAAP profit since 2023.
That is, if they don't burn all that incoming cash on their other massive project. Because the revenue numbers look great until you pivot to the capital intensity of the business.
The balance sheet gets genuinely terrifying here.
Yeah, let's talk about catalysts and risks, starting with the Foundry segment and their capital expenditures. Because the cash drain is just structural and immense.
It really is. In Q2 alone, the Foundry segment, which is their division dedicated to manufacturing chips for external companies, it posted an operating loss of $2.1 billion.
That's just in one quarter.
One quarter. If you stretch that out, we're looking at an $8–10 billion annual deficit just to keep the lights on in these fabrication plants.
And they aren't scaling back at all, are they?
No, Intel just raised its 2026 capital expenditure guidance to $20 billion, and 2027 is projected to go even higher. Even after slashing their workforce by 20%, their free cash flow is deeply in the red.
To understand that deficit, you really have to look at the mechanics of semiconductor manufacturing. You aren't just pouring concrete for a warehouse here.
No, you are outfitting these facilities with ASML extreme ultraviolet lithography machines. Those cost hundreds of millions of dollars apiece.
Right. It's a business model entirely defined by staggering fixed costs. It reminds me of setting up a massive, state-of-the-art printing press.
That's a good analogy.
You have to spend billions on the building, the highly calibrated machinery, the metal plates, all before you print a single newspaper. So the cost to print the very first page is basically $3 billion.
Exactly.
But if you can run that press at full capacity 24 hours a day, the cost of the millionth page drops to pennies. The problem is, Intel has built the press, but nobody is sending them any newspapers to print yet.
Capacity utilization is the entire game in this industry. Right now, their external foundry revenue is sitting at a meager $293 million.
Which is absolutely nothing when you were spending $20 billion a year.
Barely a drop in the bucket.
They announced Fortinet as their first official corporate customer, which is a nice headline, but $293 million is literally a rounding error against a $2 billion quarterly loss. Why subject the balance sheet to this level of stress?
Because the alternative is admitting permanent defeat. This is the foundation of their IDM 2.0 strategy.
Integrated device manufacturer, right?
Right. Historically, Intel designed their own chips and built them in their own exclusive factories. That model made them untouchable for decades. But when they fell behind TSMC in manufacturing tech, that whole foundation fractured.
Their chips got less competitive because the underlying manufacturing process was inferior.
Yes. So IDM 2.0 is their attempt to decouple those businesses. They are upgrading their foundries to regain process leadership, and to subsidize that massive cost, they have to open their factory doors to external customers.
So they're essentially trying to compete directly with TSMC.
Yes, and it's a massive gamble, because if those foundries don't reach high utilization rates soon, the depreciation on that $20 billion in equipment will just crush their earnings.
And that introduces the most severe threat hanging over the stock, which is capital dilution.
It's what everyone on Wall Street is terrified of.
Right. Analysts are scared that if the foundry losses don't narrow, Intel will be forced to raise external capital to fund that 2027 capex. If they issue new equity, it dilutes existing shareholders.
That fear alone puts a huge cap on how high the stock can run in the near term.
So they are walking this incredibly thin execution tightrope. They have to finish building the printing press, prove it works better than TSMC's and sign massive clients, all before the cash reserves run dry.
And they have to do this while AMD is actively trying to shake the tightrope.
Let's look at that competitive reality. AMD just posted a 34% revenue surge, and they are fabless, right?
Meaning they don't have to spend $20 billion building factories, they just pay TSMC to print their chips.
Which lets AMD aggressively eat into that legacy PC and server market, where Intel only grew 1%.
AMD's agility really highlights exactly why Intel's manufacturing transition has to be flawless. AMD focuses all their capital on design. Intel has to divide its attention.
Which brings us to the ultimate make-or-break metric for Intel, the 18A process node.
Yeah, the 18A node is essentially the promised land they've been selling to investors for years.
It's the architectural shift that is supposed to put them back ahead of TSMC, right?
Exactly. It involves entirely new transistor designs and backside power delivery. These are complex mechanical upgrades that theoretically allow chips to run faster and cooler.
So when Intel pitches to a potential Foundry customer, 18A is the primary selling point.
It is. But any slippage in that timeline, if profitable yields on 18A are delayed beyond 2027, that is a massive bear catalyst.
Because the major fabless chip designers will just sign contracts with TSMC instead.
Yep, and Intel's $20 billion factories will just sit there idle.
Here's where it gets really interesting, though. While they're waiting for 18A to come online, there is this highly speculative but potentially game-changing rumor about a partnership with Google.
Ah, yes, the EM/B packaging rumor.
Yeah, the speculation is that Intel might not manufacture the raw silicon for Google, but instead use its advanced packaging technology to produce Google's custom AI chips, the TPUs.
The packaging aspect is so crucial to understand because it represents a secondary avenue to profitability for the foundry business.
How does that work exactly?
Well, modern high-end chips are no longer just one massive piece of silicon. They are broken down into smaller functional blocks, often called chiplets, and then they are stitched together.
So advanced packaging is the tech that connects those chiplets.
Right, with high bandwidth and minimal power loss.
Yeah.
Intel has maintained a very strong technological position in advanced packaging, specifically with their EM/B technology.
So even if Google prints their actual silicon at TSMC, they might still bring those pieces to Intel to be packaged and assembled.
Exactly that. If a hyperscaler like Google signs a major contract just for packaging, it instantly validates Intel's foundry strategy.
It shifts the market perception from this money-burning pipe dream to a trusted partner of big tech.
But we have to emphasize this is currently just a rumor. The ink is not dry. And if it doesn't materialize or if AMD keeps stealing server share, the entire mathematical model for Intel's turnaround basically collapses.
Which brings us to the technicals and sentiment. How is Wall Street actually pricing a stock that is simultaneously growing revenue by 25% and incinerating billions in operating losses?
Violently. The stock is currently trading around $100.86.
But the volatility is extreme. It carries a beta of 2.28.
Meaning it is more than twice as volatile as the broader S&P 500. We saw it skyrocket 146% year-to-date, hitting a peak of $142 in June of 2026.
And then it plunged nearly 30% over the last few months. The market just cannot decide what this company is actually worth.
Put yourself in the shoes of a fundamental investor looking at these metrics. We have a company with a $500 billion market cap, $504 billion.
Yet, on a trailing 12-month basis, their earnings per share is negative $2.12.
Their net profit margin is negative 19.79%.
Despite losing money on every dollar of sales, they are trading at a price-to-sales ratio of 8.84.
In a normal market environment, an unprofitable legacy tech company trading at nearly 9 times sales would be considered absurd.
Isn't the market pricing Intel like the 18A node is already a massive success and the foundry is fully booked?
That is the exact reason institutional analysts are so cautious. The valuation is incredibly stretched. When you pay a PS multiple of almost 9 for a company undergoing a highly risky restructuring, you have entirely eliminated your margin of safety.
Meaning if they miss their targets by even a fraction of a percent, the stock will crater because all the good news was already baked in.
Precisely. And this is reflected in the Wall Street consensus. The average price target is $100.18, which implies zero upside from its current levels.
So the majority of analysts have slapped a hold rating on it.
They are essentially saying the risk of capital dilution perfectly cancels out the upside of the AI revenue growth.
But there is a massive counter-indicator to that Wall Street skepticism. While the institutional analysts are saying hold, the internal executives at Intel are heavily buying.
Yeah, so over the last 90 days, corporate insiders have bought a net 185,000 shares.
And we aren't just looking at automated purchase plans here, are we?
No, there were 31 distinct buy transactions against only 16 sells during that period.
That is fascinating, because these are the people who actually see the daily yield reports on the 18A node. They see the customer acquisition pipeline.
If the ship was truly thinking, you would expect executives to be quietly liquidating their equity.
Instead, they are opening their own wallets and buying the stock at $100 a share, despite the negative margins and the multi-billion-dollar cash burn.
They clearly believe the market is mispricing the turnaround. It is the strongest possible signal of management conviction.
But conviction doesn't pay for extreme ultraviolet lithography machines.
No, it doesn't. The external market is demanding tangible proof, and the window to provide that proof is closing rapidly. Which brings us to the catalysts we need to watch.
Right. What are the immediate hurdles coming up? What does an investor need to be watching in the next few months?
The absolute most critical event is the Q3 2026 earnings report scheduled for late October. The market is looking for two very specific metrics to validate the current valuation.
Okay, what's the first one?
First, that DCAI growth we discussed earlier must sustain a growth rate above 50%.
The AI inference demand cannot show any signs of cooling off.
Because it is the only thing funding the broader company right now.
And on the flip side of that coin, they have to prove they are stopping the bleeding in the Foundry.
Right. Management has stated that with the rollout of their Panther Lake architecture, manufacturing costs will fall by half this year.
Panther Lake relies heavily on moving manufacturing back in-house and improving process yields, right?
Which theoretically slashes their external wafer costs.
Yeah.
But the market needs to see the financial receipts for Panther Lake in October.
So analysts want to see the quarterly Foundry operating loss narrow from $2.1 billion down to below $1.5 billion.
If they fail to show that cost reduction, the fear of capital dilution is just going to take over the narrative completely.
But, Intel isn't just fighting its own internal manufacturing demons. They are running into a massive macroeconomic risk that suddenly threatens their entire business model.
You're talking about big tech capital expenditures.
Yeah. The broader market is getting incredibly nervous about it. Alphabet recently posted negative Q2 free cash flow, specifically because they are pouring so much money into AI infrastructure.
Investors are definitely starting to rebel.
They're looking at these hyperscalers and asking, where is the immediate software revenue to justify spending tens of billions on AI servers?
And that anxiety flows directly downstream to Intel. Intel's entire $20 billion CapEx budget relies on the assumption that if they build the world's best AI foundry, the hyperscalers will come knocking.
But if companies like Alphabet and Microsoft face a shareholder revolt and are forced to pull back on their AI infrastructure spending,
then the demand for Intel's future foundry services could evaporate just as they finally get the factories running. Intel is sitting right in the crosshairs of this macro AI anxiety.
So bringing this to our final verdict, what does this all mean for someone analyzing the stock today? You have a $65 billion revenue run rate colliding with a $20 billion capital expenditure bill.
You have massive insider buying fighting against stretch valuations and macroeconomic anxiety.
When you distill all this financial data, where does this leave us?
The synthesis of all these conflicting data points results in a bullish score of 5 out of 10, a dead center neutral rating.
5 out of 10.
The operational progress in the data center is undeniable, and the strategic vision of IDM 2.0 is likely the only viable path forward for the company.
But the downside is the financial reality of funding that vision. The risk and reward are balanced on a knife's edge.
You are paying a premium multiple for a company with deeply negative free cash flow. If they execute perfectly on the 18A node and sign a major client like Google, the upside operational leverage will be explosive.
But if the timeline slips by even a few months, the floor on the stock price is incredibly low.
Exactly.
It is a phenomenal corporate drama to watch unfold. You have a legacy titan betting the entire farm on one massive strategic pivot. But as we wrap up, what's our long-term view here? Is there a variable we haven't discussed?
There is, and it might fundamentally alter how you view this risk profile. It's a question that doesn't appear on any balance sheet. We've framed this entire discussion around Intel fighting AMD and NVIDIA in a free market.
Right.
But consider the massive bipartisan geopolitical push to bring semiconductor manufacturing back to American soil.
Oh, wow. Yeah, the U.S. government is increasingly terrified of relying on TSMC and the geopolitical vulnerability of Taiwan.
So how much of Intel's multi-billion-dollar foundry gamble is actually being quietly backstopped by the assumption that they are simply too important to U.S. national security to fail?
Is the market secretly pricing in a geopolitical safety net?
If the 18A node stumbles or the cash burn gets too severe, would the government ever realistically allow the last major American leading-edge foundry to go bankrupt?
That entirely changes the thesis. Are you investing in a risky corporate turnaround, or are you buying a protected national security asset? It's definitely something to think about for the long term.
Absolutely. Keep a close eye on those October earnings and the broader big tech CapEx trends.
Well, that's it for today's analysis. If you find our talks useful, please consider subscribe, like, and comment underneath.
And don't forget to check out the special 14-day trial link below in the description for StockOracle.
Right, our favorite AI-aided stock research platform. Again, it is an affiliate link, so the channel may earn a commission at no extra cost to you.
And remember, StockOracle's AI insights and valuation estimates can be incomplete or wrong, so always verify important facts yourself.
Definitely. We'll catch you on the next one.